Okay, well, hello and welcome back to Principles of Accounting 2. Uh, I'm still your host, Dr. B, and we're making it close to the very end of the semester. Today is April 15th. This course ends on April 26th. That's next Friday. That's next Friday is when this course officially ends. Okay. So, yeah, it's coming quick. We got about 10 days till the end of the course. So the great news is you're all doing very well, and I couldn't be more proud of all of you. Now, I'm not just saying that, because I'm a nice guy, because I think I'm a nice guy. Most of the time, I'm a nice guy. But I'm saying that because I really am proud of all of you. You're doing extremely well. This is probably the best Principles of Accounting 2 course I've taught at UDC in a very long time. So kudos to all of you. Thank you all so very much for a great semester together. This has been awesome so far. We're not done yet. We're getting close though. We got 10 days left of the semester. So uh, what I need from all of you, uh, in addition to this chapter, which we'll cover, it's not going to take us very long, but in addition to this, going into the classroom, here's what we got left. Okay. So here we are in week 14. Today we're going to talk about capital budgeting and investing uh, from a business perspective. Okay, so I want to keep that in mind from a business perspective. And then next week I'll host a very brief lecture, probably about maybe a half hour in length total. And it's going to be talking about this QuickBooks report that you have to submit for next week by Friday. Yeah. But also, we're going to do a review of the final exam. So, quickly mentioning those things, if you haven't looked at the report yet, or summary report, please do. How do you access it? Come down to week 15, action and expression. You'll open it up, click start attempt. I think it says start attempt. And then the instructions are going to be right here. Okay? And you'll notice that this paper should be between 800 and 1,000 words. That's not too long, okay? That's a couple of pages. Double space, sure, yeah, no problem. Whatever you feel is best. I'm not picky. I'm not a picky guy when it comes to your writing, okay? I'm not going to nitpick, oh, the format. No, it's okay, the format. Whatever format you feel is best. You want to do single space, that's fine. You want to do double space, that's fine. Okay, but it should be 12-point font, Times New Roman, and in APA citations and references. Okay, APA citations and references. That's the format of the citations and references I'd like you to write in, if you can. Okay. Again, I'm not going to nitpick that. I'm not going to be like, oh, point deductions for that. Besides the weight on the references isn't that huge, but I just want you to know that it's there. All right. So, uh, your paper should have these 10 elements: introduction, overview of QuickBooks, practical experiences, key functions and tools, challenges you may have faced, especially with either practicing with the software or maybe challenges you faced during the certificates, right? Benefits and advantages of the software. If you want to use examples or a case study, future application, how you think you might use it in the future, or even if you're not, how do you think it might be used? Conclusion, and then your references. All right. So that's the paper. That's due next Friday, not this coming Friday, but the next Friday. And we're going to talk more about that on Monday, next Monday. But I just want you to be thinking about that and maybe encourage you to start working on it now. And so that way, if you're like, oh, Dr. B, I'm not too sure about what I'm doing, can you look at it for me? You can just email it to me and I'll take a look at it for you. If you're maybe unsure if you're right on the right track or not. Yeah. So something to think about. I encourage you to start that one early though. because I think it'll take you a little bit of time. And then also next week, we'll talk about the final exam. We'll walk through it. Yep. Okay, so that's where we're heading. Where we are today is capital budgeting, investment, and analysis. For this week, you have I believe it's a discussion board, which some of you have already started, so thank you for that. Thank you, Maria. Thank you, Ashanti. It seems to be Maria and Ashanti that always start us off, and I really do appreciate that, by the way, just saying. Yeah, this is exactly what I'm looking for. Short, sweet, to the point, definitely. And then respond to two of your classmates just as you normally do. Yep. So discussion forum for this week, and of course the quiz associated with chapter 26, which is the last chapter of our textbook, by the way. And without further ado, let's go ahead and jump into it. All right, I'm going to try to make this experience today as relatable to you as possible, and also give you some examples of how this applied to me in my life through my career. Okay, so when in business, when we go to purchase property, plant, or equipment, the fixed assets, we got to figure out, number one, can we afford it? And number two, when is it going to pay off, right? Because you don't want to just buy property, plant, and equipment and not have it ever pay off, meaning break even, right? So you got to think about these things. We got to compute a couple of things in order for us to understand, is this property, plant, and equipment worth it, worth our investment? So these are the things we're going to talk about today. So when we are thinking about purchasing property, plant, or equipment, fixed assets, right? We got to think about our budget, right? You got to have a budget for these things. Most businesses don't have hundreds of millions of dollars just stashed away in a bank account somewhere to go buy property, plant, equipment. They don't. They just don't have that kind of cash sitting on hand for those types of investments. They just don't. Okay. So companies need to have what we call a capital budget. We go through a process to create this capital budget in order to help the business understand if purchasing property, plant, and equipment is worth it in the long run. Okay, the budget tells us these things. The budget helps to guide us, and the budget provides, I'll say, a sense of if purchasing this property, plant, and equipment is going to be worth it. Okay, so here's the definition that our book gives us. Capital budgeting is the process of analyzing alternative long-term investments and deciding which assets to acquire or sell. That's a nice definition. I like it. It speaks to what it is. Here's how I want you to think about this. Let's say your company is trying to decide between two different kinds of manufacturing equipment. They both make the same thing. All right, but we don't know which one is going to be right for our business. One can produce 50,000 units a year, and the other one can produce 40,000 units a year. Okay, you might say 10,000 units is not that big of a difference. So, and the one that can produce 40,000 units a year might be $100,000 less than the one that can do 50,000 units a year. So what I'm trying to say here is that you're trying to decide between these two different pieces of machinery. How do you know which one's better, right? The one that can produce 50,000 units and costs $100,000 more, or the one that can do 40,000 units be $100,000 less. How do you know? The capital budgeting process helps us with making this decision. So what happens? The manager submits a proposal to purchase one or the other, one of these two machines, right? The proposal includes things like the purchase price, the cost, the installation, the maintenance expenses going forward, all those kinds of things are laid out in this proposal. So we get the total cost, and we also, in accounting, we do this thing called depreciation. We also need to know how long is it supposed to last. So we'll take that into consideration. And then we also like to know, well, when's it going to pay off? Meaning, when am I going to break even on this machine after I produce how many number of units, right? Things to think about. So the manager gets all that in writing, submits the proposal for both machines, and then the capital budget committee, who's usually a group of managers within the company, sits around the conference room table and evaluates the two proposals, and they make a recommendation to approve or reject based off of the information. And of course, once one's approved, it goes on to the board of directors for it's a final approval, and it goes into what we call the capital budget. Some parts of the decision-making process you need to be aware of, and there's really four important ones. Okay, because when it comes to capital budgeting, we're talking about purchasing, usually, property, plant, and equipment. And with that purchase, there's a lot of risk involved. All right. So it's important to understand these risks. So what are the four risks that we have that are most common in the decision-making process? One is that the outcome is uncertain. Meaning, if I go buy that one piece of machinery that produces 50,000 units, how do I know I'm going to be able to produce 50,000 units? You see, the outcome is uncertain. The second risk is a large amount of money is usually involved. Yeah, we're talking hundreds of millions of dollars usually. Okay, so that's a lot of money for the company to be putting up to purchase this property, plant, and equipment. So that's a big risk, especially if the company needs to figure out debt or equity financing to purchase that machinery, right? So am I going to use debt, meaning get a loan from the bank, or am I going to use equity, meaning sell shares of stock to get the cash to buy the piece of machinery? Oh, something just happened. Y'all still there? Hello?
Yeah, we're still here.
Okay,
We're
I don't
still
know what
here.
happened there. That was kind of weird. Sorry about that. Can you still see my screen?
Yeah.
Okay, cool. Yep, sorry about that. I have no idea what happened. Um, Thank you. Okay, so yeah, there's large amounts of money that are involved in purchasing property, plant, and equipment. Uh, the investments are always typically long term, but you already know that. When you purchase property, plant, and equipment, those are long term assets. We use them for more than 1 year. That's what makes it long term in the account. And these investments typically last several years. In thinking about my machinery example, I'm going to use the machinery for as long as it'll last, ideally. But that also means I'm going to be paying for it for a long period of time. So it's a long-term commitment. And the fourth largest risk is the decision may be difficult or impossible to reverse. Once you've committed to the seller that's selling you the piece of machinery, you said, hey, I'm definitely going to buy this. Here's a letter of intent, or here's a down payment can't come back a month later and be like, oh, I'm just kidding. Oh, no big deal. Not when we're talking about hundreds of millions of dollars. Okay. It's always difficult or impossible to reverse the decision once it's made. So those are the four biggest risks with capital budgeting. Now, what happens when we decide to buy? All right. Let's say I got this piece of machinery over here that I'm really interested in buying, produce the 50,000 units. Okay, so I did the evaluation process. I went to the board of directors. They approved the 50,000 unit machinery. I figure it'll last 5 years, maybe 10 years if I'm lucky. So there's an initial investment up front that's going to cost the company money, right? This initial investment is the price of acquiring that piece of machinery, right? It's the purchase price plus the insurance plus the installation plus the training plus the whatever equals the total acquisition cost of that piece of machinery. All right. So I got to pay all that up front to the seller. How you get the money, that's another story. You're either doing debt or equity or both financing to get that cash to then pay for it, right? That's the initial investment. So I acquired the piece of machinery to produce the 50,000 units. Now here I am. I'm using it. All right. I'm using it. I'm producing 50,000 units a year, hopefully. And I'm selling, you know, 40 to 45,000 units a year, hopefully. So as I'm selling those finished goods, I got cash coming in from my customers, right? Ideally. And then, but I also have expenses going out as I'm using the machinery. I got things like direct labor, right? Yeah, I got raw materials and factory overhead. You remember those things? We've been talking about that for several weeks now. Raw materials, direct labor, and factory overhead. You know that those are things that it takes to create goods, right? All those things cost money. Those are my expenses as I'm using the machinery. But of course, I also have small other expenses like that fall under factory overhead, like um, maintenance on the machines, that type of thing. And then once the machinery has reached the end of its useful life, or maybe even before, let's say the project ends, I'm going to dispose of or sell that asset for salvage value, right? Or scrap value. This sounds an awful lot like when we talked about depreciation, doesn't it? Because it really works the same way. Now, one of the things we got to figure out before I decide to purchase this piece of machinery is how long is it going to take for me to recover my initial investment amount? Right. If I go and spend $100 million on this piece of machinery, okay, and I'm producing 50,000 units a year with it, how long is it going to take me to recover that 100 million? I don't know. We call this the payback period, how long it takes to get paid back. Paid back your initial investment. That's why we call it the payback period. Payback period is the amount of time it takes to recover the initial investment amount. Okay, so here's the formula for the payback period. We take the initial investment cost of acquisition for that piece of machinery, divided by annual net cash flow. You may remember annual net cash flows from the end of Principles of Accounting 1 when we talked about the statement of cash flow. All right. The statement of cash flows, as you recall, has three different categories on it. We have operating activities, that's the day-to-day operations of the business. Investing activities, that's the purchase or sale of property, plant, and equipment. And then we have financing activities, that's things like loans and stocks and bonds, etc. Okay. So the annual net cash flows, that is the total amount of cash coming into minus the cash going out of the business, all right, for operating activity. Cash coming into the business minus cash going out of the business for operating activities, that gives me annual net cash flow. Cash coming in minus cash going out for operating activities. That's annual net cash flow. That's how we calculate it. I'll show you that. I'll show you an example here in a second. Managers prefer projects with shorter payback periods. Yeah, no kidding. The shorter amount of time it takes for me to get paid back, yeah, I'm going to like that option best. Makes sense? All right. Here we have an example. Our company, Fast Track, that's cute, manufactures exercise equipment and supplies. We are considering investing in a piece of machinery to produce a new product. So we need to gather some very important information to evaluate this decision. First, of course, is the cost of the machine, which is $16,000. We also consider how long it's going to last for. We call that useful life. In this example, the machine will last 8 years. At the end of its useful life, it'll have a salvage value of 0, meaning at the end of its useful life, it's not going to be worth it. We expect that we're going to be able to sell 1,000 units per year using this new piece of machinery, and the sales price per unit is going to be $30, which would mean we would have annual sales revenue of $30,000. Okay, so we got all that information in front of us here. Now, let's take a look here. How we found net cash flow. We took our sales, expected sales, $30,000 per year, minus all of our expenses to produce and sell. Okay, like materials, direct labor, factory overhead, expenses are going to be $16,500. Our depreciation expense per year is going to be $2,000 per year for 8 years. That gets you to 16, right? Selling and administrative expenses, we estimate will be $9,500. So from this, we can say 30,000 minus 16,500 minus 2 minus 9,500 will give us an annual income, net income of 2,000. All right. So that's the income side. And then we have cash outflows. The cash outflows are going to be direct materials, direct labor, factory overhead, and selling administrative expenses. The reason why we don't include depreciation on the cash outflows is because depreciation is not cash. Remember, when we depreciate an expense, it's an expense, but it's not cash. We don't physically pay $2,000 a year for depreciation. We just devalue the piece of machinery by $2,000 per year until it reaches the end of its useful life. You see, you might want to look at the chapter on depreciation from Principles of Accounting 1 if you need a refresher on that, okay, on straight line depreciation. Just in case you need a little refresher. It may have been a little bit of time for some of you, but that's how we do depreciation now. So for the cash flows, we take the cash inflow, $30,000 in sales, minus the cash outflows, 16,500, and the 19,500. So 30,000 minus 16,500 minus 9,500 gets us down to $4,000 net cash flow per year. You'll notice that at the top of the slide it says payback period with equal cash flows. This assumption says that we're going to have the same amount of cash coming into and out of the business every single year for 8 years. All right. So using that information, we're going to calculate the payback period. We take the initial investment of 16,000 divided by the annual net cash flows of 4,000. This means it'll take 4 years exactly for us to receive our initial $16,000 investment back. See how that works? So that's doing it assuming that we're going to be receiving the same amount of cash coming into the business and going out of the business every single year for the 8 years. But most of you are smart enough to know that most businesses don't have the same amount of cash coming into and out of the business every single year. All right. So another model is that we can look at this using what we call unequal cash flows. Under this assumption, it says that our cash flows per year are going to fluctuate like they do in most businesses, right? So here we have an example. The same data, okay? Same data. 16,000 cost, 0 salvage value. It's going to last 8 years. Here's how it looks with unequal cash flows. When we do unequal cash flow calculations, the best way to do this is in Excel or just write them out year by year, okay? We take the initial investment minus 16,000 and then we add in each year of net cash flows per year until we reach 0. You see what we're doing here? We're kind of working backward in a way. We started with minus 16,000. We want to get to 0 because when we get to 0, it tells us the payback period, right? So let's take a look. In year 1, our net cash flow was 2,000. That means we would have a cumulative balance of minus 14,000. Year 2, net cash flow was 4,000. That brought us down to 10. You see? Year 3, another 4,000 coming in. That brought us down to 6 in year 3. Year 4, another 4 came in. That brought us down to minus 2. Okay, that's good. Year 5 brought in another 4. Oh, we're at positive 2,000. We must have hit the payback period sometime between the end of year 4 and the end of year 5. Okay, when exactly did it happen is what we need to know. I want to know what month, So it happened between years 4 and 5. So how do we figure that out? How do we calculate that? Here's the method. We take, as you can see here at the bottom of the slide, we take the 4 years, because we knew it took at least 4 years to get there, plus 2,000, which is the amount we went over by, divided by the $4,000 of net cash flow for that year. So 4 years plus 2,000 divided by 4,000. Well, we already know 2,000 divided by 4,000 is 0.5. So in other words, 4.5 years. You see how we got there? It's the easiest scientific way to get to the exact month. Yeah, so 4.5 years, that means it happened in year 5 in the month of June. Okay, so that's payback period with unequal cash flows. Any questions on that? I know that one can be sometimes a little tricky. We doing okay, everyone? I haven't put you to sleep yet, right?
Oh yeah.
Okay. Thank you, Tom. Appreciate it. All right. Let's keep rolling. So, there's some good things and not so great things about using payback period to evaluate which alternative to go with when it comes to evaluating two potential investment decisions. Do I want to invest in a piece of machinery A that produces 50,000 units or a piece of machinery B that produces 40,000 units? I don't know. So I've run out the payback period on both of those for me to understand which one's going to be best. So good and bad things. The good things is it's easy and it uses cash flows. Now, why might not it be great? Because it ignores cash flows after the payback period. Once I hit the 4.5 years, as you saw in that last example, I don't care about the rest of that 5th year and beyond. I don't, because I broke even. And, once I break even, I don't care. Why not? So I consider that a weakness. And the other part is that it ignores the time value of money. As you recall, when we talk about time value of money, we're looking at things like interest rates, right? Yeah, you gotta know, how much money, how much interest am I making on my money? Interest rates, time value of money. Um, whether you're paying or whatever the story is. So it ignores interest rates or time value of money. So that's why the payback period is maybe not the best method to use. So what is the best method to use? Well, it depends. It really depends in what it is that you're trying to prove to management in making this decision. Another method that we like to use in evaluating these investment decisions is called the accounting rate of return. Now, the accounting rate of return shows us the investment's actual income. Okay, and then we divide that by the average amount invested in it. All right, I know it sounds a little weird, right? The annual income divided by the average investment. The idea here is that we are using this to select the investment with the highest accounting rate of return. Right? That's the whole concept. The highest rate, when I'm evaluating the difference between one piece of machinery over another, I'm going to go with the highest rate. So that's why we would use accounting rate of return as an alternative or in addition to the payback period. So the formula for the accounting rate of return is the annual income divided by the average investment. Now, how do you find an average? We've talked about this before. When we're looking for an average in accounting, we take the beginning plus the end divided by 2. Now, when it comes to the average investment, we're going to take the initial investment amount of the piece of machinery plus its salvage value, beginning and end, you see, divided by 2. So in this case, going back to our piece of machinery for 16,000, 16,000 plus salvage value of 0 divided by 2, 16 divided by 2 is 8, 8,000. Now I plug that into my accounting rate of return. Annual income, $2,000 for the year, divided by 8,000 average investment. That gives me an accounting rate of return of 0.25, which is 25%. All right. So 25%, that's good. That's a good accounting rate of return. But of course, the higher the better. Now, what's wrong with just using the accounting rate of return? Once again, it ignores the time value of money. I'm not taking interest rates into consideration. And also, it does not consider the cash flows and their timing. You may recall from Principles of Accounting 1, we talked about the timing of collecting from our customers when we talked about accounts receivable. Our customers pay us at different times. I got some customers that pay me over the counter, and then I got other customers I got to chase down, you know. And so the timing makes a big difference, right? So that's what these are the two reasons why it's not always best to only rely on the accounting rate of return. You might want to also consider the net present value. Now, personally, net present value, well, and professionally, net present value is going to give you the most accurate, I'm going to say accurate, the most accurate data possible for making a decision. Now, why is that? Because it considers things like interest rate. Okay. So net present value applies the time value of money concepts to future value inflows and outflows. It applies time value of money to future value inflows and outflows. So we can figure out which project or investment in which piece of machinery is going to be the most desirable. We calculate net present value and by doing these two things. Number one, we discount the future net cash flows from the investment as what we call the required rate of return. Now you might say, what is the required rate of return? Why do I care about it? Required rate of return is oftentimes called the hurdle rate, or most commonly, the cost of capital. This is the average of the rate the company must pay to its lenders and investors. Cost of capital. It's kind of like you go to the bank, you take out a loan, that loan costs you something. It's the cost of capital. It's the interest rate. You don't just, oh, I'll take out money, I'll pay it back. No, it's going to cost you something. It's interest rate, yeah, cost of capital. So we look at the interest rate. And then we subtract the initial amount of the investment. Don't worry, I'll show you what it looks like. All right. Our company is, let's say we're looking at a different piece of machinery now, okay? This one is $20,000, all right? We expect that we are going to have $10,000 of even net cash flows for 3 years. Our company has an internal rate of return of 9%. All right. So now that I know what my internal rate of return is, I go to what's called a present value table. All right, a table. It's a chart with a whole lot of numbers in it. And on one side, you'll have a dollar amount. On the other side, you're going to have percentages, or I'm sorry, you're going to have years and you're going to have percentages. Okay, years on the y-axis and percentages along the x-axis. All right, and we're going to use this table to find number of years, come over under that percentage to find our value. Okay, that's what trying to define this, what the chart looks like. Great thing is you could just search for present value chart or table, and it's going to show up. It'll show up, I promise. Just do a simple Google search for it. It'll come up. All right. So you might be wondering who publishes these charts. The IRS. All right. Okay. So here's how it works. We take the net cash flow per year and we multiply that by the value at that percentage, 1 at 9%. 1 at 9% for year one, the value, according to the table, is at 0.9174. So 0.9174 times 10,000, I get 9,174. Right? I do the same thing for year two and year three. So here I can figure out the net present value. And the way I do that is I add the present values for years 1, 2, and 3, and I get 25,313. I subtract out my initial investment, 20,000 for the machinery, to equal net present value. In this example, $5,313. Now, in this case, number one, that tells me, my payback is obviously 3 years for this piece of machinery. But number two, it's greater than zero. When your net present value is greater than zero, it's a good investment. So in this case, I would suspect that management will decide to purchase the piece of machinery. Right? If the net present value is greater than zero, we're going to do the investment. In most cases. Okay, this slide just kind of summarizes this point that I just made, is that when the net present value is greater than zero, we do the investment. It's also a very easy, simple way to look at the net cash flows. So we take present value of net cash flows minus initial investment equals net present value. If it's greater than zero, we do the investment. If it's less than zero, we do not do the investment. Right? This comes in handy when you're looking at a lot of different options. Let's say we're looking at 3 different pieces of machinery, okay, to purchase. We got one that does 50,000 units a year, another one that does 40,000 units a year, and a third one that does 35,000 units a year. All right. Oh, three different pieces of machinery. They're all real close in price. I don't know which one to get. Well, one of the best ways to do it is to calculate net present value. Right? That's why it's really, really helpful. And there's a lot of different options. So yeah. And of course, whatever is the highest net present value is usually going to be your best option. Here's another way to look at it. Uh, this is net present value looking at annuities. Now, I can already hear you, Dr. B. What's an annuity? I don't know what you're talking about. I've never heard this word annuity before. Some of you probably have. And in fact, I would say all of you probably use this in one way, shape, or form. You just don't know that that's what it's called. On an annuity payment is a payment of the same amount over time. You may know this because maybe if you're of a certain age, you might be collecting Social Security. All right? That's a form of an annuity payment to you. Or you might be paying a mortgage or rent, and it's the same amount every month for years, right? That's a form of an annuity payment. All right, it's the same amount every year for a long period of time. That's what the word annuity means, right? So just to keep it easy for you. So we can simplify the present value calculation looking at it from an annuity perspective. Here we have a series of cash flows, which we consider an annuity because it's the same amount every year. In using that same table for present value, we can find the net present value. It's the initial investment cash outflow plus the net cash inflows for the 3 years. 20,000, I'm sorry, minus 20,000 plus 10 plus 10 plus 10, right? You reach end of year 0. 10, 10, 10, 20. For the three years at $10,000 per year, I find that on the net present value schedule at 9%, it's 2.5313. 2.5313 times the 10,000 is 25,313. Initial investment minus the net present value cumulative 25,313 gives us a total net present value of 5,313. It's the same exact concept. It's just looking at it from a different way, you see. Let's look at it from one other angle. Well, two other angles. This one is called net present value applying the annuity assumption to strategic plans. In business, oftentimes we run our business based off of what we call a strategic plan. This plan is usually for 3 years, 5 years, 10 years down the road. And the strategic plan has objectives and goals set by management for us to attain. Right? That's the idea. So, in looking at a strategic plan, we can apply net present value to determine whether that strategic plan is right for us. So here we have an example. Net present value for a manufacturing company looking to invest in a piece of machinery that's $80,000. This investment could reduce total labor costs by $15,000 per year for a period of 10 years. Okay, that could be a part of the strategic plan for the business, is that their goal is to reduce labor costs. And they usually give some arbitrary percentage, right? So the company will use the 10% discount rate because it's saving on labor. And a subject rate is 0 to determine whether this investment in this new piece of machinery is worth it. So, just as before, we take our net cash flows times the present value at the internal rate of return, or discount rate in this case, 10% on our annuity table. Yep, our net present value table. And we come down the table and it shows us that the value is 6.1446. So I take the 15,000 times the 6.1446 to get net present value cash flows of 92,169 within 10 years. I take that present value minus the initial investment, 80,000, to get a net present value of $12,169. That's net present value for a strategic plan. Now, all of those examples that I just showed you, you'll notice that the net cash flows were all the same, right? Same amount every year. Again, we all know that that's usually not the case. So it's important for you to understand on the basic level that when we're comparing one machine to another, we also need to understand that the cash flows are probably not going to be the same. So let's run out these examples. So here we have two potential investments in two different pieces of machinery. Machinery A, machinery B. We do the same types of calculations. We take the net cash flows for each piece of machinery at each year, multiply that to the value found on the net present value table at the internal rate of return, or discount rate, or required rate of return, percentage. In this case, 10%. We find the value. We take the net cash flow times the value to find the present value of net cash flow. We add them all up. We take that total, subtract it from the initial investment to find the net present value. Now, in just looking at that example, from evaluating between these two pieces of machinery, I would suspect that management would go for machinery B in this case, simply because the net present value is higher than the other. And remember, if it were 0 or below, we wouldn't do it at all. So we go with the highest value in almost every case. Now, what if there's salvage value on the machinery? You know, we've been talking about salvage value is 0, but what if there's a salvage value? Okay, no problem. We just need to make sure that we include that salvage value in our calculations. So we got our net cash flows from years 1 to 10. This piece of machinery has a useful life of 10 years. We got our net present value of the cash flows. Now we figure out the salvage value at year 10. Let's say in this example, we have a salvage value of 10,000. At the end of year 10, we multiply that by the 10% rate at end of year 10, which is 0.3855, found on our net present value table, giving us a net cash flow of $3,855 when we sell it or scrap it. We add the years 1 through 10 plus the salvage value to get a total of 96,024 minus the initial investment of 80,000, getting us a net present value of 16,024. Now, I will also say, because I can hear you, Dr. B, you're just rattling off numbers, man. I don't know. I don't know what you're doing. I can hear you saying that. I can. Well, the great news is that Excel is like really good at this stuff. Oh, and not to mention, for those of you who are as old school as I am, What the hell's my calculator? Okay, well, I had my calculator here at one point. I don't know where it is, but financial calculators are out there. Okay, so if you're ever faced with calculating net present value on something, just remember that the internet has built-in financial calculators. All right, your phone probably has a financial calculator built into it. So just keep that in mind. These tables, they're great to look at. It's nice to know how to do the calculations, which is why I'm showing you all this stuff. But just remember, we have tools available to help us to make these calculations happen. You know? As I mentioned, it's really important to go through these exercises when looking at more than one potential investment, whether it be in a piece of machinery or a project or whatever. We go through things like the payback period, the accounting rate of return, net present value calculations, time value, other time value money calculations. And we even look at things like the profitability index. Profitability index is useful when it comes to ranking these different potential investments. You got more than one potential investment here. In this example, we got three. We use what's called a profitability index to tell us how profitable the investment is going to be in the future. It's an index, it's an estimate, but it gives you an idea of which one's going to make the company most profitable, you see, from the investment. Uh, Anything above one is good. And of course, the higher, the better. So the way we calculate the profitability index is we take the present value of the net cash flows and divide by the initial investment. And here we have three different potential projects, we'll say. And so we take that present value net cash flow divided by the initial investment. And as you can see, we do that for each project. In this case, project two is going to be the most profitable. So I'd probably go with project two. And then after that, I'll go with project one. And I would not even consider project three because it's below one. It's all about the ranking. Now you've heard me use the term internal rate of return, an accounting rate of return, hurdle rate. These are all finance terms, right? Now this is an accounting class, not a finance class. But in accounting, we need to understand these terms specifically, especially when it comes to capital budgeting, which is what this chapter and discussion are all about. Because as accountants, we have to oftentimes establish this capital budget, you see. So one computation that we do is called the internal rate of return, or the hurdle rate. Okay. So this is how we calculate it and look at it. First thing we do is we compute the present value factor for the investment project. We take the initial investment divided by the annual net cash flows, as you know. That helps us define the present value factor. Second thing we do is identify the discount rate or the internal rate of return, yielding the present value factor. Let's walk through an example. Here we have an initial project with an initial investment of $12,009. I don't know where the 9 came from. I mean, whatever. divided by annual net cash flows of 5,000. This gives me a present value factor of 2.4018. Now that I know it's 2.4018, I can work backward on my present value table. I'm looking for 2.4018 on this huge table. So I go down to the table and I find it. And that same value is sitting at year 3 at 12%. So, in other words, this is another great way to find how many years and at what percentage. Excel and calculators are very handy when it comes to doing those kinds of things. Just saying. All right, we're almost done. When it comes to the internal rate of return, using unequal cash flows, it gets very complex, which is why I'm not going to show you exactly how that's done. But I'm going to tell you why we do it. For unequal cash flows, as you know, the cash flow is going to be different each year. So we need to figure out how or if we're going to invest. And the way that we do that is if the internal rate of return is greater than the hurdle rate, meaning the accounting rate of return or minimal acceptable rate of return, then we'll do the investment. If it's less than, we will not. You don't have to worry too much about that. I just want you to know. This slide summarizes the 4 different methods that we went through when it comes to capital budgeting. We talked about the payback period. That's how long it's going to take me to get my initial investment back. Okay. We looked at the accounting rate of return, where we consider things like the income percentages, and it's very easy to compute. We looked at net present value, which takes into consideration things like interest rate. Yeah. And we looked at the internal rate of return, which takes into consideration other aspects of things. This slide just easily summarizes the pros and cons to using these 4 methods. Now, when it comes to making these kinds of decisions, don't just use one method. Use them all. Okay, use them all. Calculate them all. And then go to your management and say, hey, I read through the calculations on these investments, and this is what I came up with. If you, I'm telling you, you do something like this, you blow management out of the water. I'd be so shocked. They wouldn't even know what to say, really. But you go through that process, I mean, yeah, you're gonna look like a hero for sure. So, understanding exactly when the payback happens, the payback period, is really important. But it's not just the time, right? It's also understanding exactly when that point happens, the point in time. We call it the break-even time. The break-even time measures exactly when I recover that initial investment. It's kind of like when we talked about the payback period. I said, 4.5 years. I would assume 0.5 means in June, right? And most of the time it does. But what if there's uneven cash flows or, so we try to be as specific as we can when it comes to finding the exact payback period in terms of time. And that's what this chart shows us. But it's not just the payback period. We're looking at it from a perspective of present value. So that's where that table comes in handy. And you find the table, you run out the calculations, you come across. And then we know that the break-even time is going to be where we've recovered our initial investment. And in this example, the one I'm showing you here, the break-even time occurred between years 3 and 4. When specifically? I would suspect probably 3.5 years. How do I know for sure? It actually happened at 3.64 years. So, middle of July. How did we calculate the 3.64 years, you might be wondering? We took 1,805 divided by 2,800. In other words, we took the cumulative present value of the net cash flows at the end of year 3 divided by present value of net cash flows for year 4. That got us 3.64. So that's how we found 3.64 years. Break even in exact time. Uh, Excel. Excel is your friend. Okay. There are a lot of great built-in features in Excel for calculating things like net present value, internal rate of return, accounting rate of return. Um, there's a lot of endless possibilities with Excel, especially in the finance world. So, if you haven't played around with Excel and all of those awesome features, I strongly encourage you to do so because you'll find that it is a very powerful tool. You can really impress people with it. So just food for thought, right? Okay, we made it to the end of our discussion today on capital budgeting and investments. Uh, I thought it was a good discussion. Is anyone confused about anything we talked about or need any clarification on any of this stuff? Anything at all? Did we do okay? Really? You're all good?
Yeah.
I'm amazed. 'Cause I tell you what, this is, for most students, the hardest chapter because it's finance. Finance, um, accounting and finance they're related, but they're not they're not the same. Accounting and finance are very different subjects. You can get a whole degree on finance, you get a whole degree on accounting. Some degrees have both. Um, but it's uh, what the reason why that this chapter is at the end of the course is because it's designed to help to kind of bridge what you're learning in accounting into your finance course. So for those of you who are going for the bachelor's program in any school for business, you'll take a finance course. Um, it'll probably be corporate finance or introduction to finance or whatever. But this kind of helps to bridge that gap because it's good for students to learn accounting before finance. And the reason for that is because the terms that you learned about in accounting are going to be really important for you in the finance course, right? Because a lot of the calculations that you learned in this course, you're going to see them in the finance course. It gives you that advantage, yeah? So, any questions, comments, concerns? Let's recap, okay? Here we go.
I have a question.
Oscar, please.
Yeah, but it's about the final. Is the
Okay.
final gonna cover all the chapters or it's just gonna cover?
It's only going to cover, I'm glad you brought this up, Oscar. This is a good time. Okay, so uh, back in week 7, long time ago, almost 7 weeks ago, you had the midterm exam. And as you remember, the midterm exam covered chapters, I think it was 16 or 17 to 21. All right, that was the midterm. And then we had some weeks, you did some QuickBooks stuff, and then we went through budgeting, more budgeting, standard costs, all decision making. And then here we are, capital budget 26. So what that means, Oscar, and the rest of you, is that the final exam, and yes, I'm still in the student preview, so I'll show you this. The final exam is going to cover chapters 22. You see budgeting. You see it right here, right? 22, 23, 24, 25, and 26. Okay? So chapters 22, 23, 24, 25, and 26 are on the final exam. That's 5 chapters. There are 25 questions on this exam. That means that there's 5 questions per chapter. And not to mention, Oscar, they go in order. So chapter 22, first 5 questions. Chapter 23, the next 5 questions. 24, the next 5 questions. It's designed the same way that your midterm exam was.
Okay, thank you.
You're very welcome. So as long as you go slow, open up 24 PowerPoint, open up the exam, answer the first 5 questions, close that part. You see what I'm saying? Keep doing that. You'll be all right. It's open and available to you now. So if you want to open it up and look at it, you can even answer a couple of questions. Just make sure you click save and close. Once you click submit, though, it submits it. You see?
Okay, got it. Thank you, Professor.
You're very welcome. Great question. So what we'll do is, so for this week, for this Sunday, you need to do 2 things. The week 14 discussion board, which Maria and Ashanti got us started off. But thank you, Maria and Ashanti, for doing that. Appreciate that. So the discussion board, original post Thursday, responded to classmates by Friday, and then the chapter 26 quiz. Those 2 action items are due by this Sunday night. Next week, when we come back to lecture on Monday, we'll talk for, however long we need to, maybe 20 minutes, half hour, and we'll talk about the QuickBooks report, and we'll talk about a review for the final exam. That's the plan. Okay? Comments, questions, or concerns?
No.
All right. Awesome. Thanks, Chris. I appreciate it. Okay. Thank you all so very much for your time today. I sincerely appreciate all of you and all of your hard work. Let's not stop now. We only have 10 days left in this course. Remember, everything must be submitted by the end of next Friday, the 26th. April 26th is when everything is due. So, if you want to work ahead, you're more than welcome to do so. Okay, I know that some of you have already done that, and I thank you for that. You're more than welcome to do that if you want to, okay? Thank you all so much for your time today. Appreciate all of you. Have a wonderful rest of your night. Thank you so much.
Good night, Dr. B.
Good night.
Thank you. Take care. Bye-bye.
Professor,
Yes, Oscar.
sorry, I have another question.